What is the difference between term life and permanent life? So right off the bat, I'll tell you there's a few different types of life insurance. There's term life, there's whole life, and there's universal life. Those are the three primary types of life insurance. Pretty much every type of life insurance falls underneath one of those types of insurance. Now, there's different companies out there that have their spin on each of those, but that's pretty much the primary categories that they fall under. And so the simplest way, starting off, the simplest way to explain term life insurance is that term life insurance is like auto insurance. You have it for a set amount of time. At that end of that period, the insurance expires, and you can opt to renew it at that time. The whole point of the insurance is to protect you or your loved ones, to provide coverage for you during that time. That's the sole function of the insurance. So you have auto insurance, you have it for a period of time, you have no accidents, the insurance now at the end of that term is gone, and you have to get insurance again. Now, some people kind of get upset about this idea. They're like, well, I paid for the insurance all this time and I didn't use it. Yeah, that's the idea. You don't want to use it. You want to outlive it. You want to go way past it, right? That's the whole point. The insurance is there in case of an unforeseen or an early, unexpected event, right? I'm 48. I plan on living till I'm in my 80s, 90s, 100 years old, right? I mean, I want to live that long. But if something happened to me tomorrow, I get in my car, I have a car accident. Shoot, these days, you go to a darn country music concert and some nut job shoots you, right? I'm sure nobody going to that concert that evening felt like that was going to be their last day. Yet for 58 people, it was, right? Life, throws unexpected events at you. And so that's the point of term insurance, term life insurance. Term life insurance is the cheapest form of life insurance, right? So that is the main description. I tell folks it's just like auto insurance. That's probably the easiest way to think about it, because most everybody understands auto insurance. Most of us have auto insurance. And so it's an easy concept to grasp. You have it for a period of time. You're paying solely for the protection during that period of time. Should an unexpected event happen, then the insurance kicks in, right? We all hope to outlive our term life insurance. Trust me, right? So then that brings us to what is the difference then, or the other types of insurance. Basically, you can describe, and somehow I just made it go away. I didn't mean to do that. Here we go. I was going to go back to there. So that brings us to permanent life insurance, right? Most people don't know the phrase permanent life insurance. I get asked, like, what's the difference between term life and whole life? Most people know the phrase, at least I'm seeing this, so, if you don't know, don't feel bad. But most folks, when I talk to them, have heard the term whole life. Within the category of permanent life insurance, you really have two flavors. You have whole life and you have indexed or universal life. I'm sorry. Whole life or universal life. And within the universal life, there's multiple flavors, and within the whole life, there's multiple flavors. Universal life started out really like in the 80s, and from universal life, they went to variable universal life, and now they have indexed universal life or fixed indexed universal life, right? The universal life went through those metamorphoses really honestly because they were dialing in what was working and wasn't working with universal life. And they've really gotten to the point where they've got a really good products out there. Multiple different companies have great products, and I'll kind of get into that in a second here. But that's the two different categories, term and permanent. Within permanent, you have whole and you have universal life. The permanent life insurance is designed such that once you get approved for the life insurance, it never expires. You have it for your entire life. And so no matter what, at some point you will realize the death benefit. All right. Jeremy Moore says, I'll put it up on the screen now, So just give me liability. You know what? That's a great analogy, Jeremy. And it's worth being on the screen. And I'll explain why. I'll go back to it. There are, and so, you know, I've covered the kind of the two categories, right? We have term and we have permanent. Term life and whole versus index universal life or universal life, that sort of thing, right? Jeremy said, just give me liability. Well, I get asked this question now all the time. After I explain the two differences, the very next logical question is, well, what should I have? You know, what makes the most sense? And here's where, you know, it kind of starts getting a little bit deeper because they have different functions, right? And this is where I get kind of upset with some life insurance agents. I don't, you know, I'm not going to be too hard on anybody. I'll just say it this way. In every industry, there are people who are ethical and there are people who are less ethical in their approach. Life insurance agents, I will tell you, get paid by selling the face value of the policy. So if I sold a $50,000 benefit versus a $500,000 benefit, I'm making 10 times more money, generally speaking, and sometimes that varies, but there's nuances to it. But generally speaking, that's how it works. So when you talk to life insurance people, a lot of times it's not about how much do you really need versus how much can I sell you, which is annoying. And we had another question here. Are these accidental or natural causes policies? Okay. Every policy out there, Eric, that's a great question. Every life insurance policy that I sell covers accidents, right? So whether you get cancer, die of a heart attack, or get killed in a car wreck, it's all the same. Now, you can add on to that policy what they call accidental death benefit. And what that means is, let's say you have a $100,000 policy. I can add on an accidental death benefit that will pay you $200,000 or sometimes even $300,000 in the event of an accident. You're in a car accident and you get killed, your plane crashes, you get killed, that sort of thing. Accidental death benefits. I will tell you statistically, dollar for dollar, not worthwhile. I'll mention it to folks, but I rarely sell it just because based on statistics, your odds of dying in an accident are significantly lower, such that if you take that extra $8 or $10 a month or whatever it would have been and just use that to put into investments or whatever else, you're going to come out better doing it that way. So once again, I'm unselling life insurance and I'm costing myself money. But my goal is to really get you into what is best for you and your family. So I'm going to shoot straight with you on that all the time. And unfortunately, that costs me money a lot of times. So anyway, that'll really be the case when we get into talking about permanent life insurance and when I explain how they work. So anyway, answering your question, all accidents, natural causes, even suicide. I get that question on occasion. Suicide is covered with most life insurance after 2 years. You can't just go out and buy a policy because you're thinking cray-cray and you want to take care of the family, so you go buy a policy and then end yourself. It doesn't work that way. You have to have the policy a couple of years before that event. But I have known 4 people in my life that they took their own life, and one of them was covered, and his family was taken care of. So yeah. And thank you. I try to be the man. So let's go back to Jeremy's question here. So just give me liability. All right. Now this really gets into what is the function or the purpose of life insurance. I got to quit hitting my desk here. When I talk to folks about life insurance, they really have different functions in what they're performing. Term life insurance is cheap. As Jeremy's basically made the analogy, it's liability insurance. It's the minimum insurance. And for most folks, you've seen me post in the last few days, man, I can get some crazy great rates for most people. It is crazy cheap. I've had a single mom, kind of reach out to me. She's like, Joe, it was off the Facebook page. It was just instant message. She's like, I can't afford a $1 million policy, but I need to get something in place, And she's a single mom. She has a 10-year-old daughter, and not knocking down the big bucks to where she's got a big savings account, something happened. Now think about that. Single mom passes away. She leaves a 10-year-old. Can you imagine the stress in those people's lives if something happened? It's her family and that sort of thing. So I just quoted her a $50,000 policy that was for 10 years. That gets her daughter to where her daughter's at least 20, right? That still doesn't solve the issues if mom passes away and she's a 20-year-old, but at least now she's an adult, right? And that policy, you know what that policy was going to cost the gal? $10.81 a month. $10.81 a month. And she's 52. She actually had the kid, on the older side. So, at 52 years old, $10.81, I'm like, oh my God, forego a couple Starbucks and at least your family has $50,000 to take care of you and the burial and that sort of thing. Average funeral, I've read here recently, average funeral is running right around like $17,000, something like that. It's crazy. 15 to 17, I can't remember now. That's just madness to me, right? So at least this kid and her parents, the mom's parents, would have $50,000. They can pay for the funeral. They got $35,000 to take care of the kid with expenses and that sort of thing. So at least the family can not have to stress out right there while they're grieving the loss of their daughter or the mom, that sort of thing, where they're grieving that loss and trying to figure out where they're going to come up with money. So if finances are an issue for you, don't freak out. Reach out to me. We can get a very minimal policy in place that would at least take care of immediate expenses to give your family some time to figure that out, right? That's term life insurance. Term is the cheapest by far, right? And that's its function. Its function is just to cover you, to protect your loved ones for that set amount of time. So the idea is this, guys, is that early on in life, especially if you have a family, wife and kids, that type of thing, early on, you need more life insurance, right? The typical easy-to-do formula, your income times 10. That's a great rule of thumb, right? So if I make $50,000 a year, I should have $500,000 in coverage. If I make $80,000 a year, I should have $800,000 in coverage for 10 years. At least 10 years, right? Because then if something happens, you've got income you've got a death benefit that replaces your income for your family for that period, for 10 years, right? So a lot of times that gets the kids into adulthood, that sort of thing. Let's face it, if you're a guy, that gives the wife time, if she wants to, she can now not be under pressure to remarry because she has to. She can take her time. If she falls in love with somebody else, I know my wife would have a very difficult time replacing me. I'm just saying, so so that's what you use term for. Carmelo has a great question. Can you purchase two different types of insurance which overlap? Carmelo, you almost kind of stole my thunder here, beat me to the punch. At the end of the day, the best strategy is to employ a mix of insurance. Early on, you need a lot of coverage, right? That's what you use term life for because term life is cheap. I've posted multiple posts in the last couple days, quoted a $2 million policy for a guy, 32-year-old, in good shape, not crazy health, but that was a preferred health rate, for $90. $2 million. It was a 20-year policy. So for 20 years, if something happens to him, his wife would get $2 million, right? So she's set if anything happens, right? $90 a month. It's very affordable. Now, what happens at the end of the 20 years? Well, I don't have life insurance anymore. It's gone, right? So I have no $2 million benefit. So now you need retirement money. You need savings. That's where the permanent life comes in. Carmelo, oh man, thank you, brother. He says, you teached me how to think. Thank you, man. I appreciate that, dude. So let's continue to break this down, right? The advantage of permanent insurance is that it never goes away. You will always have it up to the day you die. So let's say you have an index universal life policy that has a $100,000 death benefit. You will have that forever, as long as you're making your premium payment, right? So let's say you get that now and you're putting in $200 a month, right? And this is totally just made up numbers, but for someone my age at 48, $200 a month, $250 a month, that'd be normal. Only for $100,000 in coverage. Where I get term life, I could probably get, a $2 million policy at my age for 30 years for that kind of price, right? $2 million versus $100,000, right? That's why you don't use permanent insurance for the face value, for the death benefit. That's not the function, right? It does provide a death benefit and some really cool features to it as well, like where you can, if you got diagnosed with a terminal illness, you can withdraw up to half of the cash value of the policy or half of the face value of the policy, whichever is greater, to use while you're going through treatment. You can, go to Disney World and all that kind of stuff because you're not going to be working full time. So they have some really cool features to them on the death benefit side. But the main advantage to life insurance that has cash value is the savings side. Life insurance with a cash value, especially when I get into looking at IULs and that sort of thing, grow tax-free. Tax-free, because the money that you're putting into it is post-tax. You've already paid taxes on it in your income, right? Through your check, that sort of thing. You put it into the policy and it grows interest, right, that is tax-free. I can pull money out of that policy literally without paying any taxes on it. None. Zero. Zip. Nada. It's phenomenal, right? Now, specifically, and boy, if you guys are out there with kids, chime in on this. Let me know if you have kids, because this is where my college planning background steps in, and I have a kind of a unique skill set in this that most life insurance folks don't have, is that when you understand how colleges work, when you understand how the scholarship system works, you will know that if you're putting money into a 529 college savings plan, horrible idea. I did a whole video just on 529 plans. Why? The biggest reason is that any money you put in there, it has a big neon sign on it to the college that says, I set this all aside for you. Trust me, they will take it all. Let's say you have $100,000 that you've saved in a 529 plan. When you show up to college, you fill out the financial aid paperwork, you have to answer legally. It's just like the IRS. In fact, they're like worse than the IRS. You have to answer how much money you have in a college savings plan. Now, there are formulas for these plans will penalize you for that money at a certain percentage, 5%, right? So if you had $100,000, they're going to take $5,000 off the table immediately in potential scholarships. But I will tell you, in reality, they will take 100% of the money off the table because scholarships don't go to people who deserve them. Scholarships are just marketing dollars. They use scholarships to attract the parent. The dollars go to the family where it will have the biggest impact on that family choosing to come to the school. That's how they use scholarships. That's the truth. That's the reality, all right? So if you show up with $100,000, let's say college is going to cost your family $150,000, and you show up with $100,000 saved in a 529 plan, they're going to look at that $100,000 and go, that's all ours. Now you have $50,000 left over to pay, sir. And we know you can save money because you had $100,000 saved up. So we're sure not going to give you any free money. So we're just going to give you student loans for this $50,000. Now, skip that strategy. Let's jump over to looking at Index Universal Life. You take that same $100,000, you put it into an Index Universal Life policy. It's growing, it's earning interest, doing all this awesome stuff, tax-free. But when you fill out the paperwork for the college now, there is literally only one place that remains liquid, easy access, that they cannot see, and that is cash value life insurance. It will literally tell you in the instructions, the FAFSA, the free application for federal student aid, which was last year 68 pages of instructions for 6 whole pages of questions. That's it. They will literally tell you in the instructions do not include cash value life insurance. So you can take these kind of policies and put money into them for college in a brilliant way that will infinitely position you much better to receive scholarships and grants. Think about it from a logical standpoint. You show up to college, option A, the exact same students. You have same grades, same everything, identical student. One family has $100,000 saved in a 529 plan that they have to disclose to the college. In the other option, you have $100,000 saved in a index universal life policy, which they can't see, doesn't know exists, and you legitimately answer to them when they say, how much money do you have saved for college? Zero, goose egg, because it's in my universal life policy. It's not saved for college. That's my retirement. That's what I'm saving it for, and that's a legit answer, right? And so now, which family do you think is more likely to get a scholarship? Knowing that the scholarships aren't just going because of merit and because we like your kid and all that kind of stuff. Trust me, that barely enters into the factor. They're going to look at you and say, which family will this scholarship have the biggest influence on coming to our school? Family A says we have 100,000 saved up. Family B says we have none saved up. So if I gave family B a $50,000 scholarship, that's going to have a much greater impact to a family who has nothing saved than family A who already has 100,000 saved. So I'd much rather put those funds where the college can't see them. Now I sit down with that college. The college says, okay, well, we're going to take that 100,000 and you owe us 50,000 in student loans. Option B, they say, how much money you have saved? Zero. College says, oh man, that's terrible. Well, we can give you 75,000 in scholarships, but you're going to have to come up with the other 75. Great. I go back to my pile here, pull out 75. Thank you. School is paid for. I still got 25 G's left over. That's a heck of a lot better scenario, right, guys? So the best strategy then is, as Carmelo asked, he said, Eric, I'm going to get to your question. Carmelo asked this question, that I've got on the screen, can you purchase two different types of insurance which overlap? That, Carmelo, is the best strategy. Early on in your life, you need more life insurance, right? Because if you die unexpectedly soon or sooner than we expect, that sort of thing, your family is going to need more money to last, right? But now let's say you make it to, I'm 48. Let's say I buy a 20-year term policy. I'm 68 years old now. Well, obviously, if I die now, my family needs a lot less money to make it. They're all into their adulthood. My wife is, getting older with me. She needs the less dollars to live on, all that sort of thing. So the idea is that you use term life insurance early on in life to cover that death benefit, that face value, as it's called, to protect your family if something happens early on. You blend that with an IUL, which grows and earns interest, and it will never expire, and the face value will increase. In fact, the policy will reach a point after you put so much money into it that it is earning enough interest that you wouldn't even have to pay money into it. The benefit would still be there. Now, you would want to continue to put money into it because it's like a savings account. It's going to grow in value. But you would reach a point where the death benefit is actually increasing, right? Just because the cash value of the policy has increased. Now, it takes a little more showing and doing the paperwork and that sort of thing, and showing you illustrations and how it works. But that's the perfect way to set up your life insurance, right? So early on in life, for myself, for instance, as a business owner, I've got other values out there that I need more insurance. So I have $2 million in term life insurance. So if something happens to me now, I've got one policy that for my partners where they will take that money and buy me out so that they don't have my wife as a business partner. They love my wife. They don't want her as a business partner. Trust me. So $2 million for term life policies, and then I have IULs for growing my interest in savings, so that later on in life, those $2 million policies are going to expire. I'll be left with just IULs, which I'll have $100,000, $200,000 in life benefit. So if something, when I pass away, my family will get, $100,000, $200,000. But the idea is that I'm also building a savings and I'm growing my retirement income that I can pull out tax-free. Tax-free. You can't say that about 401ks, all that kind of stuff. It's brilliant. It's a brilliant way to save and grow money. Big fan. So now to get to another question here, Eric said, what kind of policy do most employers use? So they have term policies that are group policies. But it's basically term. Here's the big disadvantage with work policies. I tell everybody this. This is a critical thing. If your only coverage is through work, bad scenario. If you get fired for any reason, tomorrow, fired, your insurance goes away. You no longer have insurance. And so the difficulty is, let's say you get diagnosed with oogly googly disease tomorrow, right? And oogly googly disease is an uninsurable disease, right? So life insurance companies won't cover you anymore. But you're like, hey, great. Now, I'm not stressed because I have life insurance through work. But 2 years from now, you leave that job. Life insurance goes away, and you can no longer get insurance because you're uninsurable because of the oogly googly disease, right? Always own your own policy and look at your work policies as extras, as bonus, as, icing on the cake, right? Budget for your own money. And if you have the option between, getting the work policy, they'll take out money from the check to give you a life insurance policy. I don't care if it's even cheaper. Use that money, get yourself a term policy on your own that you own. You always want to own your own policy so that your job isn't in control of that. Okay, a couple more questions. Carmela said, can I buy some sort of insurance on my employees like Walmart did or does? Yeah, you actually can. There's multiple different things. Carmelo, they have like key man policies. So for instance, Randall, Troy, and myself, we all have key man policies on each other so that if something does happen, the business is the beneficiary of that policy. Right now, in my case, as owners, we use those key man policies to buy out the shares from our partners so that our spouses aren't, owners in the company. But you can do this for key personnel in the company just the same. Let's say you've got a guy that's been with you, 10 years, who's the head of your operation, and if he died, it would be devastating to your business trying to find somebody to replace him, right? So it's not uncommon that businesses will take out policies on key individuals to be able to sustain that business while they're finding that level of employee to replace that guy. So yeah, that's not uncommon at all. You can also, companies set up group policies and do that sort of thing and give their employees the option to buy their own, life insurance. If you have employees, I'd be happy to come in and sit down with them and go over that. There's a bunch of different ways you can structure it. You can pay for it yourself as the monthly. It's pretty darn affordable. It's a nice benefit. So there's, you got options. I'd be happy to talk with you, Carmelo, about that. Eric said, you think IULs are better investments than a 401k, and can you transfer 401k to it's IULs, by the way, Index Universal Life. You can do 1035 exchanges. You can roll money into it. With a 401k, you have to do it a couple different ways. It gets a little complicated, but it can be done. Do I think it's a better investment than a 401k? Abso-freaking-lutely. Abso-freaking-lutely. And here's why. I'll explain why. All right. It's the tax the seed versus tax the harvest. I'll tell you, generally speaking, anything that has a number in it, I don't recommend doing. 529 plan from the state, don't do it. 401k, don't do it. 401. Here's why. First of all, I just ask a few simple questions to walk you through this thought process. With a 401k, who came up with the idea of the 401k? Do you know? Most people, I shouldn't say most. Some people know, some don't. The IRS, right? So my first question then following that is, do you believe that the IRS is looking out for the best interests of your family, yes or no? No, right? I don't think the government, exactly. I don't think the IRS is looking out for your best interests, right? So let's now follow this thought process through. The idea of the 401k is that you are putting off or deferring paying taxes on this income until a later date, right? Generally speaking, do taxes go up or do taxes go down? Think that through. So first thing is you're putting off paying taxes. So the question to ask is, taxes higher later or now? Generally speaking, taxes go up. So we're deferring until taxes have gone up. Now, every now and then, I'll get a savvy person here that interrupts, and they're like, but Joe, my taxes are going to be cheaper in retirement. Not so. And here's why. When you are younger, you have far more deductions. While my tax rate right now may actually be 28%, my actual tax rate isn't 28%, right? I didn't make $100,000 last year and pay $28,000 in taxes. Made $100,000 last year and I paid $13,000 in taxes, or less, $6,000, $7,000 in taxes, so that my effective tax rate is really 6-7%, maybe 13%. That's my effective tax rate. That's what it's called. Now, in retirement years, you lose a lot of the deductions that you have. Your kids are grown. They're out of the house. Deductions gone. House is paid for. Deductions gone, right? So that your effective tax rate actually ends up being higher. It says, man, can you do my taxes, Law? You know what? I pay good money for a tax person. I'm not a tax expert, but that is an investment that is worthwhile. Let me tell you, you don't know what you don't know. And I started getting back a lot more of my money in taxes than I did before. I just paid through the nose, and that was that. So trust me, it's good money spent to have a tax expert, a CPA tax specialist, somebody who specializes in taxes. So, and I've never been audited, knock on wood, whatever, never been audited. I don't do anything shady. In fact, this is just so you know, just for fun. This is literally what I told my tax person. I said, I need you to operate under two principles. Number one, I never, ever, ever, ever want you to do anything, even remotely gray area or shady. Never, right? Second principle, the IRS is an illegal entity that is a violation of the Constitution who should not exist. They do not deserve a penny of my money. Now, marry those two thoughts and do my taxes. That's literally the speech I gave my tax person. So, let's figure that one out, right? So anyway, getting back to finishing the conversation, I'll kind of wrap up with this, and if you guys have any more questions, I'll be happy to answer. How does it compare? So you're putting off taxes to a later period when your taxes are going to be higher, right? And on top of that, when you take money out of your 401k, you're going to pay a lump sum in taxes to the government. So you're going to take a big hit, like a third of it gone to the government. Now, you reverse that scenario. You pay taxes now when your effective tax rate is cheaper. You take that post-tax money, put it into an IUL. It grows. It earns interest for the rest of your life. It's building in volume. You can literally pull money out of it tax-free, not paying any taxes, right? There's a way you have to do it. It's not complicated at all. I mean, it's really not at all, right? The difference being you don't want to get to your retirement years and say, okay, I want to cash in my policy and I'll close it out. If you cash it in, now you have to pay capital gains tax. You leave it open. I mean, why would you want to get rid of this, policy anyway? It's a permanent policy that you're going to have till the day you die, and you're going to get a death benefit. Why wouldn't you, right? You pull money out of it as a loan to yourself that you don't have to pay back, and you don't pay taxes on it. It is literally tax-free. That's a hell of a lot better strategy than, giving massive chunks of your money to the IRS. I've seen formulas ran for multiple different people on 401ks versus IULs. IULs kick the butt of the 401k every time. All right. Now, you talk to a financial person, and they'll poo-poo life insurance every day, day in and day out. Why? Their big beef is it's expensive. Right? Life insurance is expensive. The cost of the life insurance eats up too much of your savings dollars, so it won't grow. Right? Absolutely true. Absolutely true. I will now also ask those financial gurus the same dang question about their mutual funds and everything else that they put you in that has insane management funds. And if you went to any of the big box investment companies, I won't throw any of them under the bus because there's plenty of good people there, but all of the funds they happen to put you in, I've seen this so many times dealing with the college planning stuff. All of the funds they happen to put you in, all of the funds that happen to be the best funds for you happen to be the big box brands of funds. What a coincidence. Because the funds make money for them like crazy. I guarantee the management fees for most financial advisors on your funds are as much as or far exceed the cost of the life insurance. So, having said that, now let me better explain here why or how to use that IUL, and I'll wrap up with this. And this is where what I said in the earlier part of the show, right? Not everybody, and it's all industries, but it's certainly rampant in the life insurance industry. Not all life insurance people will want to set up an IUL for you the way that's best for you, because literally doing what's best for you screws the life insurance agent. Like, I make the least amount of money when I set up the policy where it's best for you, which is really sad that that's the way the industry has it structured. But remember, I told you that life insurance agents get paid to sell you face value. So the way you set up an IUL that works best, that really performs, is it's literally in the policy, it's called minimum death benefit, maximum cash value, all right? So you structure the policy in a way that your death benefit is as small as possible. In other words, I want as little life insurance as I can possibly get for this dollar that I'm putting in here. That way, the actual cost of the life insurance is as minimal as possible, and as much of the money that you're putting in is going to earning interest. That's how you structure an IUL, to where it will kick butt, perform, take names every day. And I've done that for a bunch of different folks in setting up their college plan. I just did it last month for a guy that has 2 little kids. They're years away from college, but he's got it structured now that when his oldest hits 18, he's got $25K per year for 5 years for each kid. The other kid comes up 2 years behind. So there's going to be a 2-year period where he's pulling out $50,000, and then 2 years where it's 25 and 25 on each end that don't overlap. And he's got that already structured in the life insurance policy. He's going to have plenty of money to do that, and then he's going to have money left over so that he has money for retirement. Now, the idea is that he doesn't have to pull out that $25,000 and $50,000 a year for college, because it's hidden where the college can't see it. He gets to keep it, and it goes all to his retirement, which is a hell of a lot better strategy. And that's what I try to set up for my clients. So that having that knowledge on the college side and the college scholarship side definitely is an angle of knowledge that most life insurance people don't have. And for that, to be honest, most financial planners don't have. Even the highest trained financial planners literally only have about 2 paragraphs of training for college, and it has nothing to do with understanding how the colleges work when it comes to scholarships and grants. I understand that side of it way better than any financial planner, I guarantee it. So anyway, that kind of wraps it up. Carmelo said, "Thanks for the education. You just sold me 2 policies. Call me when you're done teaching." I love it. Carmelo, absolutely, brother. I will give you a shout, and appreciate you, being on the deal. Eric, appreciate you tuning in on the feed. If you have any more questions, I know that you and I are going to be getting together soon with the wife. I know you've got a busy schedule over the next couple of weeks. We've already talked about that. So no rush, man. I'm not going anywhere. God willing, I'm not going anywhere. So I'll be here whenever your schedule frees up, and we can sit down and get into this a little more. Lissay, I didn't even know you were on. Why didn't you say hello? Thank you for tuning in. I'm so glad you were on. I haven't seen you in forever. I would love to get to sit down and chat with you guys. And I know you have a couple kiddos, so we need to talk life insurance and making sure your family is properly protected. I will tell you guys in closing, this company that I've been with is phenomenal. I love them. The company I was with prior was good. In comparison, no comparison. They're phenomenal. Their support is amazing. And through them, I have the ability to quote through over 50 A-rated or better companies. And I will say there's probably about 4 companies that get 90% of my business, just because they're fast, they're good, they've got a good rating, and they're consistently more affordable. I will tell you, I am loyal to none of them. All right, I like certain companies more than other ones, but at the end of the day, it happens on a regular basis where I'm like, wow, for this person, the 10-year and the 20-year, company A is the best price. But on, the 30-year policy, company A is way more expensive. For whatever reason, it just, hits their tables differently, and it'll be another company that has a better product, a better price. And I go with the apples to apples, making sure they're good, comparable policies, but the one that gives the best price for my customer, period. Well, that's how I operate. So anyway, appreciate you guys tuning in, and hopefully that was educational. I've had the question come up a lot in the last few days, so I wanted to make a video for it so I could have it somewhere to point people and say, hey, watch this video. So thanks for being a part of the live feed. Appreciate your questions, and some great questions, and hit me up, shoot me a message if you have further questions. I'm always happy to help out. If you want a quote for your family, I can knock it out in no time. So just let me know, and I'll be happy to take care of you guys. Peace out. Thanks for being a part of the little program here. Bye.